the U.S. is heading into a recession, and we may be in a recession. Everyone's like, "Wait a second! Yesterday, GDP was up 5%, and it was. That was the number for it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. When wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after 2 pretty strong months, and they were strong, the consumers just hit the brakes. Now, they've done enough to make the third quarter strong, but going into the fourth quarter, they may just not show up for the game. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December 2020, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low. Like, they spent the savings they had, they didn't make new savings, and then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while, but then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and I'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25%. So people are tapped out on their credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards. And they're just backing away. And it's showing up in things like gasoline consumption. It's way down. The demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shop, whatever it is. You're just going to buy the gasoline even if you don't like the price. By the way, lately prices have been coming down a little bit, which is another, that sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes around late August, early September. The fourth quarter could be a disaster. The stock market's starting to wake up to that fact. So I would say it's a pretty simple recommendation, Matt. Reduce your exposure to stocks overall. Increase your exposure to cash. It'll give you, you won't lose money on cash, assuming that inflation is not bad, and it'll give you a lot of optionality. You can go, if things get really, really, really bad, if you have cash, you can go shopping and find some bargains. But if you're in stocks and they go bad, you're just going to lose that money and never see it again. But if you do have stocks or some stocks, I would look at energy, defense, not for good reasons, there's enough wars going on, but defense will do well, and mining because gold and silver prices and strategic minerals will do well. So defense, mining, and energy are the sectors I'd be in. I'd lighten up on tech, get out of everything else, go to cash. Treasury notes look attractive here because interest rates are going to start to come down. I know they've been going up, I get it, but it looks like they peaked and have turned around. So treasury notes, a 2-year note, a 5-year note will perform very well, and they're very safe, obviously. And just take it from there. But you've got to be tuned into the geopolitics to understand the stock market. You can treat them as separate subjects, but if the world's falling apart, so that's not good for stocks. Right. So when we say bond markets, Matt, we have to be Careful which bond market. I'm talking about the U.S. Treasury bond market. The short-term treasuries, 4-month bills, 6-month bills, up to 1 year. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. The interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. And 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's like I say, the best of both worlds. But the highest interest rate is actually from 6 months to 1 year. So those are very, very safe securities, and they're paying like 5.25%, not quite 5.5%, but between 5.25% and 5.5% for 6 month for a 6-month treasury bill. Why wouldn't you just buy one of those? I mean, it's more than what you get in the bank. Now, the answer is, well, yeah, Jim, that sounds good, but if interest rates go up even more, you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make or lose money, but that inverse relationship kind of throws a lot of people, but that's just how it works. So yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is, if you think the 2-year note is going to go to 6%, you might not like it, because you're going to, if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to have a capital loss on the note itself. So therefore, the next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note, because a longer maturity has a higher, not to get too technical, it's called DV01, dollar value 1 basis point. And what it means is that, so interest rates come down a certain amount, 25 basis points, 50 basis points, or whatever. And I said bond prices go up, which they do. But how much do they go up? Well, the answer is, the longer the maturity, the more they go up. They're more volatile. And so 2-year notes are a really attractive piece of paper, very safe. You get your money back, liquid, you can get out of it, etc. The only reason not to buy would be if you thought rates are going to go up. I don't. I think they're coming down from here on out. But if you accept that view, then the 10-year note is going to have the biggest capital gains. Now, again, it's riskier. When I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back. But from a market risk point of view, if you had to sell it, a year from now, or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note, because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown, we're looking at all kinds of geopolitical risk, stocks are coming down, then interest rates are going to come down too.